everybody, and today we will talk about modification of orders. We'll take a look to take profit and stop loss, the most common pending orders, uh, also trailing stop, which allows you to have constant profit without limits and without screening the chart all the time. We'll take a look about four market orders such as buy limit, buy stop, sell limit, sell stop, and of course alerts, which allows you not to skip the prices in which you are interested in. With so many things to consider when deciding whenever or not to buy a stock, it's easier to omit some important consideration. The stop loss order may be one of those factors. When used approximately, a stop loss order can make a world of difference, and just about everybody can benefit from this tool. A stop loss order is an order placed with a broker or by a sell a specific stock once the stock reaches a certain price. A stop loss is designed to limit an investor's loss on the security position. For example, setting a stop loss order for 10% below the price at which you bought the stock will limit your loss to 10%. Suppose you just purchased Microsoft at $20 per share. Right after buying the stock, you enter a stop loss order for $18. If the stock falls below 18, your shares will then be sold at the prevailing market price. Stop limit orders are similar to stop loss orders, however, as their name states, there is a limit on the price and which they will execute. There are then two prices specified in stop limit order. The stop price, which will convert the order to a sell order, and the limit price. Instead of the order become a market order to sell, the sell order becomes a limit order that will not only execute at the limit price or better. A stop limit order is a conditional trade over a set time frame that combines the features of stop with those a limit order, and it's used to mitigate risk. It's related to other order types, including limit orders, an order to either buy or sell a specified number of shares at the given price or better, and stop on quote orders, an order to either buy or sell security after its price has surpassed a specified point. Advantages of the stop loss order. The most important benefit of the stop loss order is that it costs nothing to implement. Your regular commission is charged only once the stop loss price has been reached and the stock must be sold. One way to think of a stop loss order is as a free insurance policy. An additional benefit of stop loss order is that it allows decision making to be free from any emotional influence. People tend to fall in love in these stocks. For example, they may maintain the false belief that if they give a stock another chance, it would come around. And actually, this delay may only cause losses to mount. No matter what type of investor you are, you should be able to easily identify why you own a stock. A value investor criteria will be different from the criteria of grown investor, which will be different from the criteria of an active trader. No matter what the strategy is, the strategy will only work if you stick to the strategy. So if you are a hardcore buy and hold investor, your stop loss orders are next to useless. At the end of the day, if you are going to be a successful investor, you have to be confident in your strategy. This means carrying throughout with your own plan. The advantage of stop loss orders is that they can help you to stay on track and prevent your judgment from getting clouded with emotion. Finally, it's important to realize that the stop loss orders don't guarantee you will make money in the stock market. You still have to make intelligent investment decisions. If you don't, you lose just as much money as you would without a stop loss. Stop loss orders are also a way to lock in profits. Stop loss orders are traditionally thought of as a way of prevent losses. However, another use of this tool is to lock in a profit. In this case, sometimes stop loss orders are referred to as a trailing stop. A trailing stop is modification of the typical stop order that can be set at defined percentage of dollar amount away from a security current market price. For a long position, an investor places a trailing stop loss below the current market price. For a short position, an investor places the trailing stop above the current market price. A trailing stop is designed to protect gains by enabling a trade to remain open and continue to profit as long as the price is moving in the investor's favor. The order closed the trade if the price changed direction by a specified percentage of dollar amount. Trailing stops only move in the direction because they are designed to lock in the profit or limit losses. If 10% trailing stop loss is added to a long position, a sell trade will be issued if the price drops 10% from its peak price after purchase. The trailing stop only moves up once a new peak has been established. Once the trailing stop has moved up, it cannot move back down. A trailing stop is more flexible and fixed stop loss order as it automatically tracks the stock price direction and doesn't have to be manually reset like a fixed stop loss. Investor can use trailing stops in any asset class, assuming the broker provided that order type for the market being traded. Trailing stops can be set as a limit orders or market orders. Continuing with our Microsoft example, from the above, suppose you set a trailing stop order for 10% below the current price and the stock skyrockets to $30 within a month. Your trailing stop order would then lock in $27 per share because it is the worst price you would receive. Even the stock takes an unexpected dip, you won't be in the red. Of course, keeping in mind the stop loss orders is still a market order, it simply stays dormant and is activated only when the trigger price is reached. So the price you sell actually trades at may be significantly different than the specified trigger price. Disadvantages of stop loss orders. One advantage of stop loss order is you don't have to monitor how a stock is performing daily. This convenience is especially handy when you are on vacation or in a situation that prevents you from watching on your stocks for any expected period. The main disadvantage is that the short-term fluctuation is a stock's price could activate the stock price. The key is picking a stop loss percentage that allows a stock to fluctuate day to day while also preventing as much downside risk as possible. Setting 5% stop loss order on the stock that has history of fluctuation 10% or more in the week may not be a best strategy. You will most likely just lose money on the commission generated from the execution of your stop loss order. Another thing to keep in mind is that once you reach your stop price, your stop order becomes a market order, so the price at which you sell may be much different from the stop price. This fact is especially true in fast-moving markets, and stock prices can change rapidly. Another restriction with the stop loss order is make brokers don't allow you to place stop order on certain securities, like OTC, bullion board stocks, or penny stocks. Stop limit orders have further potential risk. Those orders can guarantee a price limit, but the trade may not be executed. This can harm investors during a fast market. The stop order triggers, but the limit order doesn't get filled before the market price blasts throughout the limit price. If bad news comes out about the company and the limit price is only $1 or $2 below the stop loss price, then investor must hold into the stocks for an intermediate period before the share price rises again. A stop loss order is a simple tool, yet many investors fail to use it effectively. Whether they prevent Excessive losses or this lock-in profit. Nearly all investing styles can benefit from this tool. Think stop loss as an insurance policy. You hope you never have to use it, but it's good to know you have the protection should you need it. One of the most important pre-calculated price levels used by trades today is called take profit. It's a type of pending order rated what that is placed to close a profitable position once the market reached the specific price. And the name suggests it allows the trader to set a predefined level to lock in any profits. In other words, it takes the profit as it closed the position. Take profit is abbreviated as TP. For example, a trader goes long by entering the market at 1.2980, expecting prices to rally higher. He wants to benefit from the rise, so he places a take profit order at the level higher than entry the price, say 1.3180. If the bid price hits the predefined take profit price at 1.3180, the position is closed and profits are locked in. Most traders use take profit orders in conjunction with the stop-loss orders to manage their open position. If the security rises to the take-profit point, the take-profit order is executed and the position is closed for a gain. If the security falls to the stop-loss point, the stop-loss order is executed and the position is closed for a loss. The differences between the market price and these 2 points helps define the trader's risk-to-reward ratio. The benefit of using take profit order is that the trader doesn't have to worry about manually executing a trade or second guessing themselves. On the other hand, take profit orders are executed at the best positive price regardless of the underlying securities behavior. The stock could start to break out higher, but the take profit order might execute at the very beginning of the breakout, resulting in a high opportunity cost. Take profit orders are best used by certain traders interested in managing their risk. This is because they can get out of the trade as soon as their planned profit target is reached and not risk a possible future downturn in the market. Traders with a long-term strategy do not favor such orders because it's cast into their profits. Take profit orders are often placed at levels that are defined by other forms of technical analysis, including chart patterns analysis and support and resistance levels, or using money management techniques. Suppose that a trader spot an ascending triangle chart pattern and open a new long position. If the stock has breakout of the trader expects, then it will rise to 50% from its current levels. If the stock doesn't break out, the trader wants to quickly exit the position and move to the next opportunity. The trader might create a take profit order in that is 50% higher than the market price in order to automatically sell when the stock reaches that level. At the same time, they may place a stop loss order that's 5% below the current market price. The combination of the take profit and stop loss order creates 5 to 15 risk to reward ratio, which is favorable assuming that odds of reaching outcome are equal. All the odds are skewed toward the breakout scenario. By placing the take profit order, the trader doesn't have to worry about diligently trading the stocks throughout the day or second guessing themselves with regards to how high the stock may go after the breakout. There is a well-defined risk to reward ratio, and the trader knows that to expect before the trade even occurs. You have the freedom to choose the way in which your order is proceeded, based on the price you choose to trade at. You can execute your trade at market prices via market execution or give instruction to trade a specific future price via pending order. Market execution is the most basic type of trade execution and it's used to buy or sell securities at the current market price. Trades are executed at the current ask and bid prices. The advantage of the using market order is that it guarantees that the trade will be executed. If a trader wants to get into or out a position, a market order provides the most reliable method to accomplish just that. But it can lead to the execution of an order at the less favorable price. A market with a high liquidity provides viable opportunities for market orders. Otherwise, crucial slippage can occur in trades. Stop loss and take profit can be used in market orders. And what is a pending order? This is an order to buy or to sell securities at the desired price. In the pending order, a trader instructs their brokerage to buy or sell an asset at a predetermined price. Pending order are used to execute a trade at a position that will be achieved by the market in the value. There are four types of pending orders that can be placed for execution. Buy limit, this involves the buying of the security at specific future ask price if that price matches the predetermined price. Generally, the current price of the assets is higher than the value of the predetermined price. These orders are placed because the trader expects the price of the security to drop down to a certain level and then witness a bullish trend. Buy stop also involves buying of the security and the ask price in the future if and then the price matches the predetermined ask price. Here, the current price of the assets is usually lower than the predetermined price. These orders are placed when the trader predicts that the price of the security will reach a certain level and will keep rising. Sell limit involves selling of security at a bid price in the future, if the price matches the predetermined bid price. Generally, the current price of the asset is lower than the predetermined price. These orders are placed when the trader anticipates that the price of the security will increase to a certain level and then will witness a bearish trend. Sell stop involves selling of the security at specific bid price in the future. In the price match the predetermined ask price. Generally, the current price of the assets is higher than the predetermined price. These orders are placed when the trader expects the price of the security to reach the certain level or they then continue falling. While placing pending orders, it's important to ensure adequate risk management throughout the use of stop loss and take profit orders. There are some things that traders should keep in mind while using pending orders. Determine the entry point. The trader has to calculate the minimum and maximum the price at which the trends will continue in favorable direction. Sometimes pending orders can be placed by assuming that resistance and support of the price range will break. Another way, an entry point can be determined as to wait for a release of important news. The trader will need to analyze the timing on the news and place the trade accordingly. Place and take profit. This depends on the speculation and goal of the trader. Based on the current market situation, the trader will need to assess the price of the potential gain and the probability of loss if the market changes direction there before placing an order. Placing stop loss. Stop losses are placed based on the trader's risk appetite and trading strategy. It's useful to define the terms of the expiration to ensure that the pending order is executed according to guidelines set by the trader. Both market execution and pending orders are important to make the most of types of market conditions. However, traders need to be careful and not allow emotions to color the decision to implement one of two types of orders. Instead, they should work on technical and fundamental analysis, charting tools, and other tools at their disposal to make informed decisions. And let's take a look about day trading alerts. As an intraday trader, you are presented with a number of hundreds of overcome. How do you choose between thousands of different stocks? How do you reach to news announcements before the rest of the market? This is where day trading alerts come in. Put simply, they alert you when a specific event takes place. This event could be a market development, technical indicators, or researching a specific price target. Armed with this information, you are able to act or react swiftly, increasing your chance of yielding an intraday profit. You may want to pay more attention to a specific stock, or it may let you know you need to enter or exit a trade. So you must say in use alerts every second counts when you are aiming to profit from small intraday market changes. So if the app can make you aware of relevant news announcements as quickly as possible, you can maximize profit. The best news notification is this sort of will also came with the commentary and analysis to enhance your trading decisions. Technical alerts. So these will be based on technical analysis. You can create trading alerts based on most of the popular indicators, including you can see on the screen. Most providers allow you to place and create alerts with ease throughout charts. You can also create various conditions by combining several different indicators. So you could have momentum trading alerts working along aside moving averages, for example. Price alerts. They allow you to respond to the price movements as they happen. They create instant buy and sell signals across all markets. Some providers will also allow you to choose between price level alerts and price change alerts, which will automatically reset once triggered. These life alerts often come with a risk management advice to ensure you keep losses to a minimum in case the strategy doesn't pay out. And economic alerts. If you think markets are going to respond to specific economic events like non farm payrolls, for example, you can set up an alert. Several platforms allow you to scroll throughout a tailor made economic calendar and then tick the events you would like to set reminders for. They usually allow you to specify how you'd like to notify it and how much notice you would like. For today, that is all. There was a great variety of different information, so thank you so much for your attention. I hope this information was useful for you. See you soon. Stay safe.